Today, we're diving into a method that some traders absolutely swear by and, well, others dismiss completely. It's called technical analysis. And the core idea is pretty simple, really. Can we learn to read the market's own language, using its past behavior to guess its next move?
And that brings us right to the central, and let's be honest, very debated question at the heart of this whole thing. Can the squiggles and lines of past prices really help us predict what's going to happen next? That's exactly what we're here to find out.
So here's our game plan for today. We're going to start with the basic philosophy, then we'll get our hands dirty with the analyst's main tool, the price chart. From there, we'll look at key patterns, learn how to read the market's mood, and finally, we'll tackle that huge question. Does any of this actually work?
All right, so first things first, what even is technical analysis? Before we jump into all the cool charts and patterns, we really need to get our heads around the fundamental belief that drives this entire way of looking at the market.
At its heart, it's really just this. You study historical price and volume data with one goal in mind, forecasting where prices are going. See, it's not about what a company should be worth, it's about what the market is actually doing right now.
And this is where you see the huge split in how people approach investing. On one side, you've got fundamental analysis. That's all about digging into a company's health, right? Its earnings, its revenue, its debt. A technical analyst, they pretty much ignore all of that. Their core belief is that every single piece of information, every hope, every fear is already baked into the stock's price, all driven by the raw forces of supply and demand.
So that brings us to the main tool of the trade, the canvas, where this whole story of supply and demand plays out, the price chart.
For a technician, this is their entire world. This visual record of trading history is where they believe all the market secrets are hiding in plain sight, and it's their job to go hunt for clues.
You know, charts have evolved over time to pack in way more information. We started with these super simple line graphs, literally just connecting the closing prices. Then came bar graphs, which were a step up. They added the high and low price for the day. But the most popular tool by far today is the candlestick chart, because it gives us the whole picture.
Let's break this down a bit. A bar chart is useful for sure. It shows you the high, the low, and the closing price. But the candlestick, it's a massive leap forward. By adding the opening price and color-coding the body, you get an instant read on the day's momentum. Green means the bulls, the buyers, won the day. Red means the bears, the sellers, were in charge.
And when you string all those daily candles together, you start to see a story unfold. Just take a look at this chart for Disney. Every single red candle is a day sellers were in control, pushing that price down. Every green one is a day the buyers took over. An analyst looks at this sea of red and green not as random noise, but as a visual story of the constant battle between buyers and sellers.
But they don't stop there, of course. The next step is to actually draw on top of the chart, to add indicators that help make sense of what's happening. Here on this Tesla chart, you can see all these extra lines. They aren't random. They are tools designed to reveal the underlying trends.
So let's quickly define these key tools. That blue line is a moving average. Think of it like a way to smooth out all the daily noise to see the real underlying trend. The green line is what's called support. It's a price level where buyers have historically jumped in, kind of like a floor. The red line is resistance, a price ceiling where sellers tend to show up and take profits. And when a stock bounces between those two, it's trading in what they call a channel.
Okay, so with those lines as our guide, we can move up to the next level, pattern recognition. This is where analysts start searching for repeating shapes in the chart, because they believe these are meaningful signals hidden within all the noise.
The core belief here is that market psychology doesn't really change all that much over time. Human emotions like fear and greed, they tend to create these recurring, recognizable patterns in price charts. And the idea is that these patterns can give you clues about what might happen next.
And trust me, technicians have a whole vocabulary of patterns they look for, things with names like flags, pennants, triangles. Each one is supposed to represent a specific moment in market psychology. A bull flag, for instance, represents a brief pause. You know, the price shoots up, some sellers take a little profit, but the underlying buying pressure is still there, suggesting another move up is probably coming.
Now, these patterns generally fall into two main buckets. You've got continuation patterns, like the flags we just saw, that suggest the current trend is probably going to keep going. But then you have reversal patterns, like the famous head and shoulders, which are like a big warning sign that the trend might be about to completely change direction. But you know, technical analysis isn't just about reading shapes on a price chart. It's also about trying to measure the overall mood or the sentiment of the market. It's about gauging investor psychology.
Analysts use a few different indicators for this. Trading volume tells them how much conviction is behind a price move. The odd lot indicator is interesting. It tracks small trades by individual investors, and some analysts actually use it as a contrary indicator, meaning they might do the opposite. And then, mutual fund flows can give you a sense of whether the big money is moving into or out of the market.
Okay, we've covered the what and the how, which brings us, of course, to the final and most important question of all. Does any of this stuff actually work?
Well, it is really controversial. As this quote from our source material points out, some academic textbooks don't even bother teaching it anymore. And yet, its popularity is absolutely undeniable. And that fact alone tells us something important about how a lot of investors behave and make their decisions.
Now, the argument from people who use it isn't about being perfect. It's about having an edge. The theory goes that if your patterns can help you be right just 2/3 of the time, well, you can manage your losses on the bad trades and just let your winners run, and hopefully come out profitable in the long run.
And it's so important to remember that we have only just scratched the surface here. I mean, this is a field with entire libraries written about it, stuff containing hundreds of different patterns and indicators, each with its own complex set of rules.
Which really leaves us with this final thought. What is technical analysis really? Is it a quantifiable science? Is it more of a subjective art form? Or, and this is an interesting one because so many people are watching the very same charts and the very same patterns, does it just become a self-fulfilling prophecy? Definitely something to think about.